Hi everyone, and welcome to the smart money versus retail trading case study. During this case study, what we're going to be doing is taking a look into two different styles of trading so that we can determine which one is more effective at extracting profitable trading results from the markets. To complete the case study, I'm first going to be exploring who falls into each category and what the relationship actually is between these two groups of traders, because that's very important. Then, we'll be looking at the techniques used by smart money and exploring how we can position ourselves in line with institutional capital flow. And finally, once we understand both sides, we're going to take it to the charts and practically explore examples of smart money and retail trading. Our goal for this case study is to be as transparent and objective as possible. So we're going to be looking at all relevant factors that contribute towards the extraction of consistently profitable trading results. We really hope that you enjoy this case study, and if you want to give us any feedback or just have any questions about the topics we'll be covering, feel free to simply reach out to our team and we'll get back to you as soon as we can. So with that said, let's begin. To commence the case study, I'm going to first explain in clear terms what the difference is between these two groups of traders. Retail traders can be anyone who trades in the market. It could be people who just trade as a side hustle, or it could be their entire career. The key point of distinction isn't actually based on who they are as much as it's based on how they trade. What I mean by this is the fact that retail traders execute strategies which are used by the masses of traders. In practical terms, this means they use things like indicators, which belong to the masses because they can be easily seen by the masses. So if in your trading you use analysis techniques like EMAs, Fibonacci retracements, support or resistance, or trend lines, there is a very high probability that you fit into that category of retail traders. Then we have smart money, also referred to as BFIs, banks and financial institutions. Smart money traders again follows that same style of classification. It's a style of trading as opposed to a group of traders, although it just so happens that you can also classify smart money traders into a typical group of people, which is the banks and financial institutions. You can be a smart money trader, although more commonly, smart money traders will work for private equity firms, hedge funds, or other large trading entities. It's a relatively recent occurrence that smart money strategies have started falling out of the hands of these institutions and into the hands of individual traders. And the reason why is because previously, this knowledge just wasn't available to the individual trader. Smart money traders execute strategies which are heavily focused on identifying underlying areas of market liquidity as opposed to stacking technical confluence factors such as indicators. You may not be too familiar with the term liquidity. It simply refers to trading activity within the market. For example, retail stop losses are a common source of institutional liquidity. What I mean by this is that if we know that a certain amount of retail stop losses are going to be in a location, we would consider that liquidity, because we know that if those retail stop losses were to get hit, a bunch of liquidity would enter the market, and that's the liquidity which is used by smart money traders. Liquidity identification is a very powerful technique in practice, and it's what makes smart money trading so much more effective than retail strategies, because it incorporates a much deeper level of market analysis. Contrary to what you may expect, when actually trading within the markets, it's often easier to execute smart money strategies than retail strategies once you have some fundamental understandings. So to summarize the difference between the two groups of traders, retail traders use widely available indicators to make trading decisions, whereas smart money traders use more advanced analysis to identify where and when liquidity will be available within the market. Okay, so now that we understand who the two groups of traders are, we're going to take a deeper look into the relationship between them. And I just want to say that this is probably the single most important point that you will ever hear in your trading journey. So please listen carefully and take notes when I explain this concept. The first and most important point to understand about these two groups of traders is that at all times, smart money is in control of the market. The reason why smart money controls the market is simply because they have enough buying power to move the market in their desired direction, whereas retail traders don't even come close to having this organized market moving ability. The second most important point to understand is that smart money actively uses its ability to control the market specifically to trap retail traders into fueling carefully designed smart money positions. These 2 points are so significant that if everyone watching this video understood them, there would be no need for the rest of this case study, because the final answer we will arrive at becomes abundantly clear. However, we want to make sure that everyone has an opportunity to develop a thorough understanding of these points. So we continue. If you're truly going to understand the relationship between smart money and retail, you need to be able to perceive what's really going on in the markets. There is a game which is being played here, and smart money is a step ahead of the retail traders. One of the signature techniques applied in this game by smart money is illusion. Smart money will influence the market to move in a certain way that gives it the appearance of obvious predictability. For example, if smart money wanted to, they could print a head and shoulders pattern within price action. They will even go as far as to make these patterns work out for retail traders more often than not, once again contributing to this complex illusion of retail trading predictability. When a retail trader comes to the market and sees a price action pattern playing out 65% of the time, that's going to be enough for them to perceive that they have an edge in the market. And when this occurs, smart money has very carefully guided them into a trap. It's actually extremely smart what they've done here. They know precisely how to appeal to the mass consciousness which is retail traders. You can verify that these patterns are being set up by smart money simply by analyzing this event from a highly logical perspective. Ask yourself the question, why is it that this pattern is present in the market? Price action doesn't just naturally form a head and shoulders pattern. If it's there, it's because it's been designed by someone who has enough market influence to put it there. So then, you follow up that conclusion with another question. For what purpose has someone expended a great amount of financial power to put this pattern in play within the markets? And the answer is that it's there to trap retail traders into fueling a carefully designed, high risk to reward institutional market position. The key point to understand here is that smart money plays this game with a different set of rules. Because they have financial power, they have control over the market. Now, before I even take a step forward, I want to take a moment to dispel any doubt you may have surrounding this key fact. You can verify this conclusion if you think about it logically. Markets operate using order book systems. If you flood an order book system with orders to buy, the price will be driven up. And if you flood it with orders to sell, the price will be driven down. This is known as price manipulation, and it's most commonly observed on small cap market stocks. However, here in FX, the same concept still applies, because it's universal across all markets. It just requires more capital here, which as we know is easily available to the 0.1% who make up the institutional smart money traders. Okay, let's take a step forward. Now, you may be wondering how smart money can actually generate a profit if they are the ones moving the market. This is another very important point. In the style of trade that smart money sets up for retail traders, you'll notice that there's always a very obvious and specific location for a stop loss, such as behind a Fibonacci retracement. And furthermore, there is also a very clear location for a target. These trades rarely have a risk reward exceeding 1 to 3. Now, it shouldn't be misunderstood. Some retail traders certainly do manage to make consistent profits by taking these setups. But for the vast majority of retail traders, they don't reach consistent profitability. Smart money lets the retail traders have some of these artificially designed wins, knowing that by doing so, they will be conditioning retail money to be present at very specific points within the market. Now, this is where smart money plays its game. Because smart money has conditioned retail traders to have their stop losses at a very specific point, all that they have to do is place their entries just behind the retail stop losses. Then, they will exercise control over the market and use a portion of their buying power to drive price up into those stop losses, where they will then be able to collect all of that available liquidity to enter into their own positions. Because that's an important point to understand about being an institutional trader. They can't always just get into the market whenever they want, because they have too much size. So what they need to do is use retail stop losses to enter into their positions. This is a very smart thing to do, because it allows smart money to get into the market with a very tight stop loss, even being as low as 1 or 2 pips in many trades. Once smart money has stopped out the retail traders and used that liquidity to enter into their own positions, they throw massive volume into the market, resulting in an extremely sharp move in favor of their trade. This allows them to make massive profits very quickly, and retail traders never see it coming. When it's all said and done, smart money has the capability to walk away with trades as big as a 1 to 100. Which, to clarify, means 1% risk for 100% return on investment. This does happen in smart money trading, although more often, positions are usually between 1 to 5 or 1 to 20. Once smart money has had a take profit hit, they start it all again, setting up artificially designed market conditions to trap the next round of retail market participants. Of course, smart money will lose positions at times, although often it's intentional, because they need to do this in order to condition that retail money to be present when they need it. They don't even mind taking these losses because it's pennies on the dollar compared to what they'll make when they successfully trick the retail traders. So without even hitting the charts yet, I hope you can all see that there is a highly logical structure for how smart money operates. And there's a good chance that you've probably not heard this explanation before because it's kept under lock and key. Very few people understand this truth, but this is how the markets really operate. Now that you understand how the markets really function, I'm going to briefly explain how we can position ourselves on the side of smart money. It all comes down to one simple observation. When smart money moves the market in this manipulative way, it leaves behind a trace called market inefficiency. We'll be exploring market inefficiency in detail inside of the full course, but I'm going to do my best to provide a brief conceptual explanation for you now. Market inefficiency occurs because when smart money starts to enter into its position, an uncharacteristically large amount of volume enters into the market during one very short window of time. The reason why we label the resulting price action as market inefficiency is because it's an unfair market condition. In this particular moment, the market is not working as designed. A liquid market should provide the ability for anyone to enter and exit the market at any point in time. But when smart money flows into the market, this fair market condition temporarily ceases to function because all of the available liquidity is consumed by the smart money orders. This is further compounded by the fact that smart money can afford to pay for better liquidity providers, which means they are always going to be accessing tier 1 liquidity, whereas retail traders may be down at tier 2 or tier 3, which means that you who's executing your trade as a retail trader has to purchase liquidity from a broker who has to purchase it from a liquidity provider, and they may even still purchase it from an even higher up liquidity provider. Now, as I said earlier in this case study, markets operate using an order book system. So when too much volume enters into the market at one time, price begins to move in response to that, and because of this, smart money can only enter a portion of its positions at that initial price. But remember, smart money can influence the market. So, before the major move occurs, there is often going to be a short pullback to the region of price which initiated the inefficiency. This pullback occurs because as a result of that window of market inefficiency, where the market moved so much so fast, there are unfilled orders from a variety of market participants. The orders which get left behind as a result of the inefficiency are what's known as a zone of supply or demand. It represents unfilled orders which want to get into the market. So I'm just going to briefly explain that again. Smart money gets into the market, and when they do, they move the market very quickly, and as a result of that, not everyone who wanted to get into the market at that previous price point was able to get in. So as a result of this, you get orders that are left behind, and that's called supply or demand. Now, the market itself is like a magnet that gets drawn to these areas, because at all times, it's fundamentally trying to find and fill orders, because that's what markets do. With all of this context in place, I can now briefly introduce our style of trading the market. So in our approach to the market, we identify where smart money is in play by finding areas of market inefficiency which leave behind supply or demand zones. Then, we place our own trade orders in line with those supply and demand zones. At the same time, smart money comes back to finalize its accumulation phase by collecting the remaining orders. Once they've loaded their second round of positions into the market, they push price down and collect their profits. This smart money system allows us to place trades with a risk to reward of between 1 to 5 and 1 to 100 if we use the higher timeframes, all through a pending order which is placed ahead of time. There simply is no smarter way to approach the markets. We trade directly alongside the institutional market participants who drive market behavior, and because of this, we achieve highly profitable trading results. So that's a general explanation of the theory behind our strategy without going into unnecessary amounts of detail, but now I'm going to bring in one of our head traders to explain it from his perspective on the charts.
Hey alchemists, how is everybody going? It's Lewis here. Hope everybody is doing well. I just want to jump on today and break down the introduction to smart money. And essentially I'm going to be comparing a smart money perspective to a retail perspective, and what actually differentiates the two, and what is smart money and what is retail. So without further ado, let me briefly introduce myself for some of you that don't already know me. My name's Lewis. I am a full-time funded trader. I am funded with FTMO. I've been funded now for several months. I've been trading close to a year. I was fortunate enough to come straight into the smart money background. I found a really good mentor and paid for his one-to-one coaching, and he was just incredible. And then with the understandings of smart money, I was able to nurture a system through all of the different types of teachings and strategies that have been around, and just nurtured a real simple plan, real simple strategy, and that's what we're going to be showcasing you today. So it's a short story about me. Let's get into essentially why you're here, right? So retail and smart money, what's the difference? You've heard the term smart money concepts, you've heard the term retail trader. What makes one person a smart money trader and one person a retail trader, right? It's just understanding the flow of the market. It's understanding why price does what it does. That's the key differentiation between retail trading and smart money concepts, is essentially that retail trading is based off using tools like indicators, you have trend lines and support, resistance and Fibonacci's and all of this stuff, and I'm not saying they don't work, but they just don't work as effectively. You won't get those results that you'll be able to get with us here trading retail. 1 in 10 retail traders end up being successful. In fact, less than 1 in 10. It's more like it's actually around 5 in 100. About 5% of traders actually succeed with retail. So if you was to go to a retail guru or something like this, essentially they think they know why price is doing what they're doing. So you might get a trader, literally, I'm just going to pull up now random lines, literally just random lines, and kind of walk you through what sounds like a retail guru. So I'm going to draw a random line here. I'm going to draw a random line here, and I'm going to draw a random line here, right? And I'm going to tell you now that these are key levels. These are super important levels. You'll see how price reacts to these levels, and just play price and just kind of go through essentially what retail trading is about. It's essentially thinking they know what's happening when realistically they don't. So price is moving, and they know price moving, and they're saying, okay, price is entering my first level. Go and move these. Okay, price is entering my first level. Prices broke through this level. Now price is testing this level. See, price is hovering around this level because it's such an important level. We're just waiting for it to show us what it's doing. As you can see, it's went through, bounced off it, and now it's moving away from that level. And as you can see, you could have caught a really nice trade in here just off this level, because we break through, we test it, and then we go. And you just could have caught a really nice trade in here, with your target on this line, because it's such an important level. And you just need a small stop loss like this, and you can target really this high right here, and you're guaranteed to make, like, what's that, 1 to 4 I guarantee that. So we're going to continue price, and they're going to say, you could have took price higher if you wanted to, but we're just playing it safe. And price is really moving now. Okay, see, this is such a key level. You could have caught such a huge trade from this level. This 1.26946. This is such a key level. And then just move the levels. Just put it here, here, and here. In their webinars or whatever they are, and they're like, okay, look at that, price taps into our zone, into our level. This is another key level. Could have took a short from this level. There you go, there's a huge trade, and we could have just targeted our next level because that's such another important level. We're coming back to test this level now. We're just wicking through it, just testing it, staying around it. This is why prices are reacting to this level, because it's so important. It's such a key level. Again, we're coming back to test that level. Again, as you can see, it's such a strong level, such a key level. Look, as you can see. And now we break through it. And as soon as we break through it, you can straight away buy because it's such an important level. You can just buy. And then you want to just take price into just this level here for absolute no reason. And then price goes through, and then you can sell. And as you can see, we test it, and then we come back, and then we go back up, and price is hovering around this line because it's such an important level. Look at that, price taps it to perfection, and you could have caught a really nice sell in there. And then price taps the level again, comes back to your entry, and then breaks through, and then it tests your level, comes back to test it, and then boom, there you go. You could have had a really nice long position in there. So as you can see, basically I'm saying utter nonsense. None of this makes any sense. However, it can be justified. It can be said that, okay, well, price is hovering around this level. Price does perfectly tap it and bounce off. Price breaks out, retests, and then continues. Price trades straight through it. Price is hovering around this level. You can justify it. And that's what retail trading is. It's justifying things that actually don't have no logic or justification. That essentially is what retail is. Versus, on the other hand, understanding smart money is why price is doing what it's doing. It's very easy for me to see why price is moving in this manner. So if I was to personally break down this price, I would do it in such a manner like this, right? Here is our demand level that just broke the new high. So this is our demand level that just broke the new high, and that's exactly why price comes back into this level. And now we can target this high right here, because this is a weak high. The reason this is a weak high is because this high fails to create a new low. It fails to break this low, respects this low, and therefore it's weak. If you just imagine structure, every time price comes back down, this high fails to break this low, and then it just continues, and then this low breaks this high fails to break the new low, continues, fails, continues, fails, continues, and every time in here it's just a demand level, and so on and so forth. The same with supply levels. And so that's exactly why this level holds. And then we break the high, and then you have to ask yourself the question of, where did we break the high from? So we broke the high from this level, and if I go down to a lower time frame, so a 1 hour, say, for example, let's see what it looks like on the 1 hour. As you can exactly see that this last move here is our demand level, where you could have taken the trade, could have taken a buy from, and the reason being is because this is the last point of demand that broke this level right here, causing a change of character, right? This caused a change of character to the upside. So demand is in control from here, right? So you could have targeted this level, and then, well, where's our target? Well, this is a weak high, right? Exactly the same thing as we've just seen. This high fails to break this low, and that's why price comes into this level exactly. And then we can target this. And by the way, I'm on GU. I've never traded this pair live in the markets. I just came on this pair because it's the only pair that doesn't have drawings on. EU and UJ both have drawings on because I actually trade those pairs for those who know me and for those who continue to go through the course, you'll see that I use UJ. You'll see when I break down a trade in a moment that I'm actually using UJ. UJ is what I use, and you'll see that. And so there's that trade, and God knows how long it took, but that essentially did happen. You know, your first long from this 4-hour level, and just targeting the high. It's 1 to 3. Like, that's crazy to think that 1 to 3 in how long? It's like a week or something. That's crazy. We don't roll like that around here, really. It's more like 1 to 3 in a matter of minutes. Target this high here. Again, I'm just on the higher time frames for no apparent reason. I'm just a random time frame, just to show you that I know what price is doing and why. There's a 1 to 5, and now here's another thing, right? So let's just follow the order flow, follow the structure of price. We can see that this low puts in a high. Sorry, let's go back. We can see that this low right here puts in this high puts in this low, so that's a weak high, puts in this high puts in this low, so now that's a weak high. So in between we just have this back and forth noise until eventually we break it from here, and then price does exactly what? Breaks this level, so it has a break of structure. But more importantly, the last real point of demand on this time frame is this small unmitigated candle in here, right? Because this is the demand level that put in a new high. As you can see, price trades straight through that. And where's our supply level that breaks this level, the origin of the move? Essentially, it's right here, right? Like, even if I go to a lower time frame, this is a 1 hour, but I know in this wick that's a 15-minute supply order block. You know, whatever kind of you reference them as, I reference them as supply zones. So as you can see, for those of you who know what it is, and by this point you do know, or at least you will come to know, that that's an exact supply zone order block, and that's exactly why we're going to have taken that trade. And I knew that wick was that reason. I know that's the origin of the move that broke this demand right here. So the tables have turned. We was bullish, now order flow has shifted bearish, so I can absolutely take a short at this level right here, 13 pips, which is crazy. I use like a 2 pip stop loss, and where we can target is this low right here. And the reason is because this low fails to create a new high, so it's weak, which just means it's a pool of liquidity. So as you can see, just the low, there's a 1 to 13, which is very nice with a retail, well, it's not a retail strategy, it's smart money, but it's very nice for a higher time frame. That's what I meant to say, higher time frame. For a higher time frame smart money strategy to pull out a 13R in, you know, 19th of August 20, it's still a week, it's still crazy. I catch 13R and I've caught 13R in a matter of minutes, but you know, like, and that's the reason price is doing what it's doing. Like, this is no BS, this line does this and this trend line does this and this is support and this is resistance. Like, that's all BS. All of these indicators right here, they're all man-made, these indicators. So you have to think, where does this data come from? This data comes from the central bank, right? This is an algorithm. The central bank of England own this algorithm because it's the British pound. So all these things are man-made, and what they're used for, the algorithm is programmed in a certain way that they know that people look at this, for example, as a trend line, right? So when price comes to here, people are going to start buying, and that's just a liquidity pool to me. Again, like, people are going to look at this like a double top as resistance, right? Because this high and this high are equal highs, however retail call it. And so when price gets back into that level, you know, when price comes back into this level, as it does, it just sweeps straight through and then reverses, and then goes back through. Like, it's all about liquidity, and essentially retail is liquidity. So liquidity it's just, where are the orders in the market from retail traders? Where are their stop losses? Where are retail stop losses? Where are the stop losses of the retail traders? They're in trend lines, double tops, equal highs, equal lows, triple bottoms, support, resistance, Fibonacci's, all of these things. It's what all of retail traders are using to be in these markets, and the algorithm is designed in a certain way that it will artificially manufacture those certain things that retail traders want to see, so that they can build up liquidity and generate that liquidity in the market, and as a result they build stop losses and they make money from it. It's super simple. So what I'm going to do for you now is I've shown you, this is completely random. Anyone who knows me, I don't trade GU, I don't trade these time frames. I've come to a random time in this like 26th of August 2020. Everything is completely random. The lines I drew in was random. Everything's random, like completely random. And so what I'm going to do now is go to the pair that I actually do trade. As you can see, Euro USD and US UJ, and I'm going to break down today's price action. In fact, let me just go on to a pair that doesn't have any on, because I'm going to break this down for the community later, so I want to keep the things on there. Forex.com, UJ, let's go. So let's take a look. Let's remove all of these, and then let me just give you a smart money trade breakdown of my strategy. And essentially this has only, so there's 3 laws, right? There's a guy called Richard Wyckoff who basically, he worked for like some huge hedge funds like JP Morgan's and things like this, and he understood, like, he was one of their traders, so he was taught how they traded, how they use liquidity and all of these things. And essentially one day he just came out and he just told the public everything. So he knows that markets operate on supply and demand, which is simply when supply breaks demand, supply takes control. When demand outweighs supply, price goes up. When supply outweighs demand, price goes down. Then it was cause and effect. Cause and effect is just liquidity. So for example, these double tops right here, or whatever, this is cause for price to go higher, which is why it sweeps above. That's cause and effect. And then he uses this thing called Wyckoff. He created his own kind of pattern in the chart. Like, I don't use Wyckoff. It's not necessary, but it's still pretty cool. And so that's where smart money comes from. It's not just this random thing invented by no one. Like this guy, Richard Wyckoff, who was working for the biggest hedge funds in the world and the banks and all of these things, trading for JP Morgan or whoever it was. You know, these are the guys who own these algorithms. These are the guys who own these markets. That's something you have to understand. And that's the understanding really of what smart money is. Smart money is people who know the markets. They're not just in here gambling. They're not just in here guessing, which again is gambling. They're in here understanding why price does what it does. Because when price goes up, money goes in. When price goes down, money comes out. So you have to understand why is price doing what it's doing. Build the narrative, build the story. That's all what smart money is. And that's why I love smart money so much, is because it's about building the narrative and building the story. Without further ado, let me just break down a trade or a series of trades. Just to convey what I'm going on about, and you'll see my strategy. What I just shown you is the same as my strategy in terms of supply and demand and liquidity, but it's not the same in terms of what I do. So this is today, 8 a.m. This is today, 8 a.m. This is when I get into the markets. This is, yes, Bali time. I am from Bali, or live in Bali at least, for those who don't know. So I trade the Asian time frame, the Asian session for Bali. So first things first, 4-hour chart. What's happening? Always what's happening, what's price doing, why is it doing it? So first things first is we have this level right here, this level of demand that impulsively broke supply levels to the previous, right? So that's the first thing I'm going to mark up, is understanding that this is the demand level, and as you can see, we wick below these levels before reversing. So why do we wick below? Because of retail. Like retail smart money is a thing. Like there's people that trade smart money that just have a random order on this because it's an order block, right? And they're picking up on that, and they know that. And so retail smart money, some smart money retail traders have like orders on here with stop losses just below, and their entries here and their stop losses here. And so they know that price is going to come into this level and have a reaction because it has to. That's the nature of the market. And so what does it do? It sweeps below this level. And what it does, it entices breakout traders, right? So we've had a break of structure. And then you have retail traders that as soon as structure breaks like this, as soon as structure breaks, they buy. So when structure breaks, they buy. Then it starts to come back and then they close their position, right? Break of structure, they buy as soon as it breaks. So they're called breakout traders. So as you can see that this has enticed breakout traders because it breaks the structure. So there's sell orders with their stop losses just above here. That's why we wick down and then come straight back up, because essentially we want to understand where's all of the liquidity, and then use price as reason. If I say spot the liquidity or be the liquidity. So as you can see, we have this like whatever this thing is, trend line or whatever on the lower time frames. Once again, it's just a pool of liquidity. So that happens. 4 hour spikes through. That we have this supply level here, this last up move before the down move that caused it. So price wicks through, sweeps the liquidity, taps back into the supply level, gives the reaction, taps back into a supply level, taps back into a demand level, and now essentially we're caught between higher time frame supply and higher time frame demand. And so even when the price is ranging like this, you can still trade, and I'll show you exactly how. So this is a 4 hour. We trade in a fractal nature. We break down multi-time frame analysis. So there's the 4 hour outlook, and then again we just range in between this level. Market's not really showing its hand, but on these lower time frames I'm sure we can find something. So then I'm coming to the 15 minute and I'm understanding, okay, what's price doing? So as you can see, this is where the liquidity was first swept here. Then we have this instant reaction to take out all the stop losses. So then we have supply inside of this wick here. That supply is being swept out, enticing the buyers that have had the breakouts or whatever they are, broken down, tap back into the demand that had the change of character in here. So this demand level is what put in the new high. So demand is in control from there. When we break it, that's a change of character. So that means we've shifted bearish now. So where did that come from? It came from this supply level right here. So you could have taken a short position from this level with your stops just above. It's 5 pip stop. And where can you target? Well, let's look, right? So we have double bottom. Retail know this is support or resistance or double bottoms, whatever. That's liquidity. So price will probably just go straight through that. Okay, so well, we have this demand level right here. Why is this demand level important? Because this demand level caused a change of character here from before, right? This is the supply that put in the most recent low. So when it gets broken, demand has shown that it's in control. And so this level will cause a reaction, right? So you can take this trade from here into this level. And then if you really want it, you can take a long straight out of here and target back up into the supply levels, this supply level exactly, which is why price come into this level exactly before selling back off into this demand level, before going back up to this supply level, before coming back into this demand level. So price moves supply and demand, unmitigated supply and demand. It's everything essentially. Not everything, but that's what we build our concepts off. So forget this stuff. This is yesterday, but I'm still understanding this narrative to understand why price is doing what it's doing. Okay. So price reacted to this 15-minute supply demand, and then it's come back into this 15-minute supply level, and then it's come back into this 15-minute demand level in here, and now it's having the reaction. And what has happened is, here is the unmitigated supply level, this last up move before the down move that put in this level. So if we break this level, that's a change of character to the upside, change of character up. Where did that change of character come from? It comes from this 15-minute level right here. So now this is what I'm seeing, right? I'm seeing prices ranging overall. This is just stuck in a range, but still I can see that we're reacting from demand and supply. So we're reacting from this supply to this demand to this supply. And now we're going from this supply to this demand right here, right? And then I'm assuming, okay, now we're going to go from this demand to where? This supply right here, right? Because this is the supply level that puts in this demand. So I understand where we are on the higher time frames. Now I'm going to drop down to my favorite time frame of all, the 1 minute. And now we're inside of this level and we're putting in structure. Let's just play structure for a moment. Let's just understand highlighter, low, high, equal low, respect supply, break it, back up, down, right? So we're bearish. So just waiting for a change of character, right? I'm just waiting for this to happen. At some point in this demand level, the 1 minute's going to do this and break this. And then it's going to leave it behind a demand level. And I'm going to take this demand level into this supply level. Super simple. And so play price. We're inside. We're just waiting for that to happen, literally. Okay, so it puts in another low. We're not in the market yet. Boom. It breaks, right? As you can see, this wick right here, this last up before the down that mitigated this supply level, put in the most recent low, and now we have broke that level. So that is, guys, a change of character to the upside, which means that now finally price has shifted from bearish to bullish, and we can assume that the next point where supply will come into the market is in this level. So we can go ahead and take a long position. Here I like to use a 2 pip stop loss personally, so 2.5 is cool, between 2 and 3. So there's a 1 to 8, right? So that's the first position I was looking at this morning. Play price. Price comes in, tags us in, instant reaction, very nice. Mitigates out of this level and then has this break here, right? So if I go down to the 15 second, which is something I use to refine the 1 minute. Again, yes guys, a lot of retail traders say don't trade the 1 minute, it's noise, don't trade the seconds, why would you ever go to the seconds? But understanding fractals, and you just understand that price is just price, right? What happens on the 15 second builds up the 5 minute, what happens on the 5 minute builds up the 15, what happens on the 15 builds up the 1 hour, what happens on the 1 hour builds up the 4 hour, what happens on the 4 hour builds up the daily. So price starts in these second time frames, you're just getting in early. So let's go 30 second because it's just half of a minute. Let's understand what's happened, right? So we've tagged into our trade. This is the most recent high. We've come up, we've tagged into here, we've come up, and now we've broke this level here. So this to me is a minor break of structure. And then if I look at that on the 1 minute, that's it. Essentially, it's just broke this high. So we've confirmed again, it's a supply to demand flip, right? So we've had price was bearish, bearish. We had a change of character, we're mitigated, and now we've broken the supply that mitigated this, right? We've broken this supply that come back in to mitigate this, right? And then because we've broken it, now we leave behind this, right? Which is this. So you can stack another order. It's exactly my plan and my strategy. Boom, 2 pips, where we're targeting, same area. So let's play price, tag, and away we go. Right, so again, there's 2 positions now. Nothing really to say about this, to be fair. Price is just putting in highs and lows. This candlestick just mitigating this demand in here on the lower time frames. If I go to the 30 second, there's probably unmitigated demand here exactly, that had that supply to demand flip, like so. So you could genuinely even take this with a 1 pip stop. As long as it's a 1 to 5, I'll take it. I wouldn't take this. Like I didn't take this. But like that's back in. I don't even know if it holds, to be honest. It just makes sense that it would. Yeah, and it breaks again. You could just literally do the same thing again if you really wanted to. This was a supply level. It's been broken. Here's the origin of where it was broken. You know, just literally looking at the high, just playing the mitigations, literally. And then, okay, it doesn't come into this level, no biggie. And so we get into here. There we've hit a 1 to 8, a 1 to 8, and a 1 to 8. So literally 32R, I think that is. 32R in... I come onto the market at 8, I hit the target at 9. In an hour, you've been able to do 32R, just like that. Super simple strategy, nothing overcomplicated. And that's the power of smart money, because I knew what price was doing and why it was doing it, more importantly. And that's something we'll go into more detail, much more detail, of why price does what it does in later episodes. So guys, with that all being said, I'm going to wrap that up right there, because there is a good enough example for you to understand smart money and retail, and how they're so totally different, and how I actually use retail stop losses to get into positions. I use retail setups like trend lines and double tops and double bottoms and support and resistance as liquidity pools, so that I can actually get into positions. So with that being said, I hope you all enjoyed this introduction to smart money trading. I'm now going to pass it back to Adam to complete some final discussions before wrapping up the case study. I hope you guys enjoyed, and I'll see you guys soon. Peace.
Okay, thanks Lewis for breaking that down for us. Let's talk about it. You've now had a chance to see firsthand how powerful the analysis techniques used in smart money trading actually are. But what's more important is that if you paid attention during the entire case study, you'll be able to see that there is a very strong connection between my theoretical explanation and Lewis's practical demonstration. The reason why is because what we just shared is a highly logical and reproducible trading system. Lewis said it perfectly. Anyone can say that they understand something, but to demonstrate it in practice in a format that anyone can understand is an entirely different level within this industry. Our goal for this case study was to bring together a set of information that would simply speak for itself, and I truly believe that we have achieved that goal. If you are capable of seeing the logic inside of this entire explanation, you can be a smart money trader. So, with that said, thanks for tuning into our case study, and we'll see you inside the rest of our course very soon.